YouTube, my name is Charles Enoch, and you know I'm back with another Invest in Myself video. Now today I just closed on another rental property, so I only felt it was right just to talk about the different classes of property somebody can invest in. Now most investors know that there are 4 different type of classes of properties. You have your A-class property, B-class property, C-class, and D-class properties. Now when I invested into my first rental property, I had no clue there were different classes of properties. So I just went in blindly and just bought something. I didn't really know the pros and cons and pretty much what I was getting into. So the goal on today's video is just to educate any beginners or anybody that's thinking about jumping into the rental property game to figure out what type of investor that you are. Are you focused on majority cash flow? Are you focused on majority of appreciation? Are you trying to get a little bit of both at the same time? So before we dive into this subject, please go ahead and hit that subscribe button. Help our brother build out his channel. Please hit the like button as well. And go ahead and look at all the other old videos that I have posted. They are very educational. All right, so you know I'm ready to go. I got the whiteboard in the back, and I'm ready to drop some knowledge on you guys. Let's go. All right, so we're going to jump straight into it. The first type of properties we are going to talk about are A-class properties. Now, A-class properties are going to be the best properties that you can get in the highest neighborhoods, the highest areas here. So let's go over some of the pros and cons. So one of the pros, it's going to be a newer building, probably between 1 to 10 years old. They're going to have the best locations next to the newest, hottest restaurants, movie theaters. Everything's going to be new around the community. They will have the highest rent that you can charge, just because of the area and the location is going to be very awesome, very excellent there. They're going to have high quality amenities in the household. So you're looking at your stainless steel appliances, granite countertops. Everything is going to be grade A, top of the line. And since the location's great and the neighborhood is going to be excellent, that means the appreciation is probably going to be very high, and you will see it grow rapidly every year just because of the area. Now, some of the cons with A-class properties as an investor are it is going to be a very high purchase price. When you're purchasing in those neighborhoods that are excellent, the houses are going to be priced very high and competitively priced for you to buy those. Since the rent is going to be high, but the house that you purchase is probably going to have a high purchase value, meaning that your cash flow is going to be very minimal. It's going to be lower than all the other classes most of the time. Now, another con are the repairs of the house. Now, since the house is only 1 to 10 years old, there may not be a lot of repairs, but if something goes wrong, let's say like the granite countertops, they crack or break or whatever the case may be, or the high cost of the luxury cabinets, you are going to have to pay for those repairs. And those repairs are going to be higher than maybe someone that has imitation granite countertops or things like that. So since the amenities of the house are going to be high, if anything breaks down, those repairs are going to be high as well too. Also, one thing to think about with amenities, with the newer houses, with the Class A, I mean, you're looking at things that normal people may not have in other communities, like pools. One of the last cons here are going to be the HOAs. So Class A properties, majority of the time, they are going to be in a gated community with the HOA. Now, this does help keep the appreciation high because the HOA will not let a house go past a certain standard. So if a house needs painting, then that means that the HOA will send a letter to the owner of the house and say, hey, you know, the paint is not looking up to par. Please paint it, please fix the fence. So this does help appreciation. But we have to think, as an investor, we are going to have to pay those HOA fees. Now, you can try to pass this along to the actual renter, but you never know when the HOA will raise the fees and some of the rules and regulations of the HOA, which can hinder you. And the HOAs can pretty much be a nuisance for an investor. Now, the type of investor that usually buys these A-class properties are going to be one that is not worried about cash flow. So pretty much they maybe have a stable job or they have enough cash flow that they're not really too worried about making a high profit in regards to whatever their mortgage may be compared to the rent that the tenant pays. What they are mostly worried about is very high appreciation. So they are pretty much banking on, if they buy this property, let's say the property's like $300,000, they're banking on the property appreciating at a very high, fast rate. So let's say they buy it at like $300,000 and then next year it's worth $400,000. That appreciation is pretty high and it just keeps going. So since they're after appreciation, what their investing strategy would most likely be is they're after the fast appreciation. So they are going to buy the house, put a tenant in there to pay most of the mortgage, try to even break even. Sometimes if the appreciation is very good, they will even pay a little bit out of pocket because they know that they will sell the house in return. So they would buy the house, put a tenant in there, maybe wait 3, 4, 5 years until the appreciation, they feel that it peaks at a certain level, and when the market's hot, they're going to sell it, and then they will get all that appreciation back here. So back to the example, if I bought a rental property for $300,000, put a tenant in there, and let's say I had $200 in cash flow, which isn't too much. And let's say that the house appreciates about $100,000 every year, and I wait for 5 years. That means my house will be worth $800,000. So then I would sell it, and then I would make that profit of $500,000. So that would be an investment strategy for people that are buying A-class properties. All right, now we're going to move on to B-class properties and what we're kind of looking at the pros and cons as an investor here. So pro number one, the building's going to be somewhat new, so we're looking between that 15 to 30 year range for a B-class property. Second, it's going to be in a pretty good location. Now, it's not going to be the newest restaurants and things coming out like that, but it's going to be a very established community that's going to be pretty safe, have some very good quality schools. Now, the rent is going to be above average. It's not going to be as high as the A class, but it's going to be above average for maybe the standard person. So we're going to have good quality amenities in the B class properties. Now, it's not going to have the grade A things like class A, but the amenities of the house are going to be pretty up to par. Stainless steel, maybe granite look-alike. It's going to be a very good looking house. Now, another pro of B class properties is that they are going to have both good appreciation and good cash flow. Since the property is going to be located in a pretty good neighborhood, we should see the appreciation rise. It may not rise as fast as class A, but the appreciation will be there. A lot of times for these B classes, there are going to be an HOA or gated community here, so that you won't see the property depreciate. It's always just going to kind of appreciate. They're going to keep it up to standard, up to par in that community. Now, if you do get a B class house or neighborhood, sometimes these can turn into A class houses, and then you will see the appreciation even rise even more. So some of the cons as a B class investor, The purchase price is going to tend to be average, maybe a little bit above average for these B class properties. Again, it is going to have a decent amount of cash flow. Now, what we're kind of learning here is the higher the purchase price of the house, most likely the cash flow is not going to be that high. So what I do as an investor, I try to at least incorporate the 1% rule. You ask what the 1% rule is? Pretty much how much I buy the property for, I want to apply the 1% rule. I want to times it by 1%. And whatever that is, that should be the rental value of the house, the minimal rental value. I try to at least really hit 2%, but 1% is probably the minimal. So for example, if I buy a property for $100,000, then I'm expecting the rent to be at least $1,000 minimum. If I can't hit that $1,000 minimum or that 1% rule, I probably won't buy the property. So now when we look at purchasing houses, again, the higher the house, the price of the house, the harder it is to hit that 1% rule. So let me give you an example here. If I'm buying a property and it's $500,000, the 1% of $500,000 is $5,000 a month. Now it would probably be pretty hard to get somebody to pay $5,000 a month for a $500,000 house. So if I bought a house for $70,000, if we hit that 1% rule on there, we're looking at $700 of rent. Now, when you're buying on that low end, you'll realize the lower the house price is in correlation to the rent. A $70,000 house, you may be able to squeeze $900 of rent out of that house. So that would be more than 1%. And the higher you are over 1%, that is great. That's what you're wanting in regards to cash flow. All right, so let's get back to the cons for part B. So we're looking at repair costs. They are going to be pretty semi-high here. Again, since the house is newer, you may not have constant repairs, but if something does break down, it is going to be something that's newer. The amenities of the house are going to be of good quality. So that means that if you have to repair those, the repair costs are going to be a little high. And the next con, we have the HOAs. So just like Class A properties, a lot of Class B properties do have a HOA or a gated community just to help keep that appreciation consistent and up and not let the neighborhood pretty much just go to trash, basically. So the type of investors that usually invest for Class B properties, they are wanting a good amount of cash flow and they are wanting a good amount of appreciation. So they're going to get a good amount of both here, cash flow, appreciations. You got to get the best of both worlds. You won't get the highest amount of appreciation like Class A, and you won't get the highest amount of cash flow like we'll learn for Class C, but it's pretty even. All right, so we are on Class C properties. And this right here is my bread and butter that I learned through investing, that I'm a Class C type of investor and I love Class C properties. So let's go over some of these pros here. So not really a pro, but I just kind of put it in that upper category to try to make everything copacetic here. So with the property is going to be a little older. We're looking at probably around that 30-year or more mark for the Class C properties. The location is going to be pretty average. It's not going to be the greatest location, but it won't be the worst location. It's going to be a pretty average location. It is going to have great cash flow. So like I previously explained, the lower that you pay for a house, the greater it is that you will exceed that 1% rule that we are looking for as investors, and even try to get to that 2% as well. So the amenities of the house, they're pretty much going to be of average quality. A lot of imitation, let's say countertops and things like that. They're not going to be the highest of quality. They're pretty much just going to be very standard. So the amenities there are going to be very average here. You're not looking at granite countertops, stainless steel, anything. You're going to get the very basic, minimal standard appliances and things like that. Now, the prices of these C-class houses, they are going to be very low. And since they are low, you are probably going to have to do some rehab on these properties here. Now, one pro that I love for C-class properties, you do not have to deal with the HOAs. So there's nobody telling you that, hey, you have to paint this a certain way. Hey, this is looking sloppy right here, so you need to get on this. You're pretty much the owner and you can do what you want to do. You can make the repairs when you want to make the repairs, and it does not have to look up to the standards of the HOA. Now, some of the cons for the C-class properties, you are going to get some low rents, but remember that 1% rule in regards to the ratio. You're going to get a high percent based on what you paid for the house, but overall the rents are going to be very low compared to a Class A property. And another con, we went over it a little bit, it is going to need some fixing, so you're going to have to do some rehab most likely before getting a tenant in there. Again, now the rehab is going to be very minimal. You're not looking for the most extravagant things. You're going to just put basic standard flooring, amenities in there, so it shouldn't be too much for rehab for a Class C property. Now, this does have poor appreciation since we don't have a HOA or a gated community to kind of put everybody up to standard. You're not going to see a very high appreciation. Again, you can have neighbors across the street that just let their house just go to hell, and there's nothing that you can do about it because there's no HOA. So we're really not looking for that appreciation. All right, so the type of investors for Class C properties are investors like me. So let's see what I love in a C-class property here. So not worried about appreciation. Right now, I am not worried about appreciation here. I am worried and focused strictly on the cash flow. I'm really trying to supplement a lot of my income to a certain extent. And once I have a lot more cash flow, then I may think about investing into B-class or even A-class properties that I will focus more on appreciation. But for right now, investors that want to supplement their income, maybe quit their 9-to-5 or even work part-time because you have enough cash flow through the properties, you would definitely want to invest into C-class properties. All right, so last we have our D-class properties. And these are for very special investors. So I would not advise getting a D-class property unless you know what you're doing. But we will go over some of the pros and cons and the types of investors that really invest in the D-class properties. So D-class properties, I don't have it on the board, but they are going to be definitely 30 years or older, maybe even 100 years old. They're pretty much uninhabitable right now. So those are the ones that are just kind of boxed up. Nobody's living in them. And the neighborhood is going to reflect the house as well too. So if you see a house boxed up, there's probably like 50 other houses down the whole community that's kind of boxed up. It looks like a rundown, trashy area. If you do manage to get somebody in one of these houses, it's going to be a very high cash flow because the house is going to be dirt cheap. Another pro is you're probably looking at a lot of assistant Section 8 individuals will probably be in these type of houses. So you're looking at the government actually paying you the rent. So it's guaranteed to get there on the first. So that is a pro for a D-class property. Repairs for a D-class property are going to be cheap. I mean, you're just doing the very minimal. You're not putting in anything extra or luxurious for these type of tenants. And another pro, again, very low purchase price. I mean, dirt cheap. These houses probably have been on the market for, I mean, at least a couple months. They're just willing to try to get rid of them, basically. Now the cons for a D-class property, definitely a low quality building. Again, we're looking at buildings that are probably 100 years old, 80 years old. They are going to be very old properties. Repairs on these buildings, since a lot of them are going to be uninhabitable, they're going to have major repairs. I mean, tearing down walls, maybe foundation problems. You are going to put a lot of work in these houses. Another con is these houses are in war zones, drug infested, crime zones. I mean, areas where police are even scared to go through at nighttime. You wouldn't even come through here in these type of locations at nighttime. Another con is getting good tenants in these areas. Since the area is a war zone, drug infested area, it's probably going to be hard to get a tenant in there. Even if you fix the house up and put luxurious things in there, the location itself is not going to attract good tenants. So with all this, I know it sounds bad for the D-class, and who would want to be an investor of a D-class property? It sounds terrible. But the type of investor that loves these type of properties is one that has a lot of capital, and what they are going to be doing is buying out the block. So the strategy into this, if there's a community, let's say that the community has like 50 houses, you are going to try to buy out a lot of these houses, like 30 plus houses. Even if they're boxed up, you are just going to keep buying all these houses. And then once you have most of the neighborhood, you will start fixing these houses up. Once you start fixing these houses up, the neighborhood's going to look better and better and better. And then that's when you get a group of people, a group of tenants to start moving into these houses. Businesses will come kind of moving in. That whole gentrification is what investors love, that have a lot of capital. So the D-class properties, these are the investors generating that gentrification and pretty much recreating this location. So again, you are probably going to have a lot of capital to be a D-class investor, but there is a lot of upside if you can definitely buy out the block. A lot of times investors, they go in all together. So there could be a group of 3 or 4 of them, and all 4 of them buy out the block and then just create a whole new community. Now you've bought the property for dirt cheap, and you could potentially make this D-class location to a B or even an A-class. And then that's when you'll get a lot of appreciation and a lot of cash flow. So I hope this really helped you guys out. I remember when I bought my first rental property, I just kind of went in blind. I did not know about the different type of classes of properties I could get, and kind of the pros and cons and the benefits and disadvantages of the different class of properties. This in turn made me get a property that was not ideal for the strategy that I tried to use. But it did eventually work out, and I actually love my first rental property, or the tenant that's actually in the rental property. So if you're asking, what type of property did I buy for my first rental property? It was actually a B-class property. And this property does have an HOA, which I don't like HOAs. It's the property that gives me the least cash flow, but it does have pretty good appreciation, so I can't complain on that part. So to all my new investors or somebody thinking about investing in a rental, definitely check the pros and cons of the different classes to figure out what type of investor do you want to be. So I do appreciate you guys for watching this video. You know, I hit you with weekly videos every Friday. And if you guys have not, please remember to subscribe, hit the like button, check out my other previous videos as well. They're very informative. And I have gotten a lot of you guys that are asking questions. Can you do this type of video? Can you do this type of video? please comment down below in regards to what type of videos you guys want me to do, and I will definitely go ahead and do those. So I will catch you guys next week. Again, thank you for tuning in to Invest in Myself. I will catch you guys. Peace out.